Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, active, passive, you're just kind of casually curious about the whole multifamily investing thing, you're in the right spot because every single week on the Gray Report, we're breaking down not only the latest research reports, trends, market movements, giving you insights on just how the multifamily industry works, as well as the whole real estate industry, residential, commercial, then also seeing how the macro economy plays into all of this. We've got some really great reports, things that you need to know to make investment decisions. We have a CPI print from the BLS. We have employment numbers from the NAHB, reports from CBRE, PwC, rent.com. A lot to get into. Let's get into it. All right, we're back on the report, joined by housing expert Matt Bosnog, who's also the director of communications and marketing here at Gray Capital. Matt, like we just said, a lot of interesting stuff. Reports just hit the wire this morning, a couple of days ago. I was sick yesterday. We couldn't do the report. Might have worked out because we've got the CPI print we can talk about. So all good stuff. How the heck have you been doing, Matt? I've been out of the office a couple of days. Everything's still moving over there?
Yeah, everything's still moving for sure. I've been thinking about, everyone's thinking about elections and now the CPI print came and yeah, I'm still thinking about some of the employment numbers from last week. So there's plenty to talk about.
Yeah.
And it's not just elections. So I'm excited.
No, the election seemed to be a little bit of a head scratcher. I think a surprise to many. But again, my personal opinion, like there are differences between Democrats and Republicans, but really in a big picture, there's not that big of differences. And we're going to see not a lot going to get done either way. It looks like Republicans are going to get the House. Senate is a toss-up right now. We're going to see more gridlock, which is relatively good for business because, well, a lot of times when government can get together, it's not always
expensive changes.
Yeah, exactly. Expensive changes, a lot of unintended consequences.
Yeah.
And what we're living through right now, I think, is the result of $10 to $11 trillion between fiscal and monetary policy over the last couple of years. So we're kind of living through it right now. But politics aside, I think, Matt, to your point, where you were really focusing on before we started the recording, is that the elections are important and everything. We got to track where politics are going. Much more important on a local level, though. I mean, that's where the rent control is going to happen. It's not coming from a national level, at least how I can see it right now. I don't see how that would able to happen. I don't think you have enough interstate commerce for any kind of national regime. But CPI, the economy, what the Fed is doing, we're seeing inflation, CPI ease up just a little bit, and maybe more than the CPI print is showing, because as we talked about, shelter, 30% makes up a third of that CPI print, and they still have it as like the highest it's ever been. But we know, because we do the Gray Report every week, we're in the industry, and listeners of the Gray Report, they know that we've seen rent declines over the last 2 months.
Yeah.
Now, we've talked about how the CPI, how it's calculated, is utter BS and isn't very helpful or useful to calculate rental inflation. So it'll be interesting what the Federal Reserve uses with this information and what the interest rate hike in December is going to look like. Is it going to be 25 basis points? Are they going to do another 75? It's going to be an interesting month or so, man. That's for sure.
Yeah, I was just reading yesterday that like the Fed acknowledges that there's a 9-month lag between the interest rates and their impact on the housing market. I was like, well, so let's acknowledge it. Let's put some action behind those words.
Yeah. Do you feel like, man, you start feeling like things are starting to break in a way that, okay, the Fed is getting the evidence that they need to see that their policies are moving into the restrictive territory? I mean, we see like 11,000 employees at Meta laid off this week. I think unrelated, but I'm not sure how unrelated it is. I mean, the whole crypto blow up that we saw yesterday, I mean, that's not even on the report because it's not really what we cover. But I think that's, we were waiting for like, what's going to really break. And that is a story that I think can have some secondary and tertiary effects that I don't think we're getting ready to see, of the whole FTX blowing up. And we're all still in the middle of that right now. FTX is a major
Yeah.
crypto exchange, going through a major liquidity crisis, essentially a bank run. Everyone's trying to get their
Hmm.
dollars out, and then they may not have the dollars to get back. That's just leading to this sense of where we are in the cycle right now. And
Mhm.
so is that going to give the type of messaging to the Federal Reserve, supposed to be data dependent, of maybe we need to, you know, handle back on the throttle a little bit in terms of these rate hikes? But
Right
what do you
now,
think?
just looking on it, and we've seen, we'll discuss a little bit about the employment numbers too. Is like employment numbers are a little soft, but they weren't plunging. They were also like it was all there were some positive things that you could kind of pull out of the employment numbers. It wasn't all bad news. Same with the inflation numbers. It wasn't there wasn't a huge amount of inflation, but there's still a lot. And I don't know if we've seen enough pain yet. I don't think things
Yeah.
have been dramatic enough. What's happening in the crypto market is almost the most dramatic thing that's happening right now.
Mhm.
I think for the people that were laid off on from like Meta or
Across the, I mean, it makes sense. I mean,
the tech
values are down like
industry,
50, 70%.
it
Money's
seems
not
like
flowing.
we're getting ready to maybe this is like a shift from growth to value in certain
Mm.
regard, but I still don't think. I mean, the feeling is people still have their jobs. There's not, the unemployment numbers are still very low. So I don't know if there's enough pain for the Fed. The Fed wants to see real drama, I think, or maybe they're real smart and they want to slowly glide to a stop. I just don't think they're capable of it. I think that
Yeah.
we're going to see pain before. So I think maybe if there's the next month, if things start to really go to get rocky, then maybe people will start talking about it more. But I could see another interest rate on the horizon. I don't know. It just doesn't seem dramatic enough. I was happy. That's why. So maybe when I start being unhappy, then they'll take action.
Mhm.
Ugh,
We need to gauge Matt's happiness meter
that's
to
right.
see what J Powell is going to do.
Yeah.
So Matt, this, I don't know, not controversial opinion, but question to you: if we were approaching a soft landing, or a
Hmm.
soft like let's say a soft landing happens, what would it look like? And would something that, okay, a landing means we're going to come down, but it's just not going to
Hmm.
be like horrible. We're going to like land.
Yeah.
Would that, isn't this like kind of what that would look like, of how like wages are rising,
Yeah.
unemployment
Yeah.
is low, the job market is decent, people are still have their jobs,
I
but
I
but
think that's a
then
big argument. I totally because a lot of the things that we've talked about this again in previous weeks. There's a lag to the effects of high interest rates, and so maybe we could still continue to see that lag, but I don't know, I don't know what they're looking for. Because if I almost think that they need to see that pain in order to know when to stop. So it doesn't seem to me to be realistic. Just looking at I spent a couple nights ago looking at employment numbers and the Fed rising rates, and you just see, when unemployment gets down to where we are right now, it usually goes shooting right up. And so there's a part of me that's nervous because unemployment is so low that we are on this precipice where just the slightest spark could send inflation come running up again. So that's kind of where I'm at.
yeah,
And I wish I could be more optimistic, but it is a pessimism born of this whole year where it's like all the good news are bad news, all the bad news is good news. So it's really
it's good
complicated.
news for people who love bad news, Matt.
Yeah, that's right. Nice reference.
Yeah. Um, yeah, so I think what you're talking about is, this possibility of a wage price spiral, which I think
Yeah.
that we may be, to your point, I think we're starting to get into. We're seeing wages continue to rise, and I think that especially when like a lot of the big union contracts continue to come up. I mean, railroad workers just got a big salary increase, and I heard a comment from someone recently saying that, when workers, especially organized labor, but anyone, when they're going in for a raise, they're not necessarily going to look at the 5-year forward projected average inflation rate of,
Yeah.
like 2.5 or 3%. They're looking at today 7% CPI, and that's the increase that they need,
Yeah.
and maybe a couple of those over a period of time. And so that's when all of those wages increase. We're already seeing wages increase. Um, Prices of everything else has to go up also, to make
Mhm.
up for that. And so it can be this really tough spiral. In and so maybe the recession that everyone is, I mean, one, we could already be in a recession or something like a recession, and I think we're too caught up on the definitions exactly of what a recession are, but we are in a period of contraction right now. I don't think there's a person on the planet that would argue against that.
Yeah.
Um, but if it does get deeper and harder, and we do see companies seeing their profitability sink and revenue growth slow down, but their expenses have gone up so much because of payroll, they're going to have to start cutting and being more efficient.
Mhm.
And that could, to your point, create a spike in unemployment. And maybe we do get that's what's going to really slow things down
Yeah.
quickly. But will we get there? I don't know. I
Yeah.
think still possibility we could have sort of a soft landing, or it could just be horrible. I think you have to be
Yeah.
prepared either way.
Yeah.
One thing is for sure. I mean, we've been talking about this, Matt, for months now, but people are getting excited for opportunities that are going to be coming up. I've
Yeah.
heard from a lot of, whether it's your real estate influencers or anyone, is that there's going to be some of the best buying opportunities. Maybe of our generation, but that also leads me to believe that how far can prices drop, especially in commercial real estate and multifamily and industrial, when you have so many buyers lined up ready to go.
Yeah.
No one's saying like, I'm not touching this. I mean, the only asset class is maybe office, where people saying, I'm not getting close to office right now. But
Mhm.
for other asset classes, people are like, oh, this is great. Prices are going to come down a little bit. I'm going to be able to get some good deals even with higher interest rates. There just seems like there's a lot of buyers lined up. Now, I think there won't be as many, because I think that the fear and uncertainty is going to keep some to the sidelines.
Mhm.
And so I think if there is an opportunity, it's going to be a relatively short one.
Yeah.
And it may be like now.
Mhm.
It might not be in 6 months. It might be right now, right this second.
Yeah, that's how it was, in the pandemic. There was
Mm,
fear, people held off, and they realized that the deals that they were waiting for were just not increases. It was, their deal was a little bit of price stability instead
yeah.
of, like, skyrocketing growth that we saw in the following 2 years.
Yeah, but either way, whether there's a big drop or not, there's still a possibility of an extended period of and people are talking about a lost decade or so of just like there's just not going to be much economic growth for a period of time, which is exactly the type of stuff you start hearing in the beginning of a recession, of people being like,
Mhm.
oh, this is just going to be horrible for the next 10 years, and very rarely do things last that long. I mean,
Yeah.
the Great Depression, it took what 20 years or so to kind of get back to the from where we were in 1929. I think they had to go to 1954 to break even. So yeah, a little
The
over
Great
20 years.
Recession, the Great Recession, it's just it was such a slow, slow slide back to lower unemployment, much slower
Yeah.
than
Oh yeah.
anything else. So
Much
coming
slower.
off of that, I a part of me thinks I'm no economist, but a
You're an
part of
expert,
me,
Matt. What are you talking?
yeah,
You do
that's
this.
right.
You do this for a living. You're a professional.
All right, good. But a part of me thinks that that slow slide and that kind of extended pain that we had after the recession kind of held a lot of economic energy
Yeah.
that's kind of hopefully continuing to be expressed. There's still wealth out there, and there's still economic momentum. But I to see two lost decades on 2 decades of slow employment growth, one on top of the other. I think that would be extremely unusual. But everything's
And then now this is like coming from a place of like relatively no data, but I just don't believe that we could have a decade of no growth, because um we won't let that happen.
Yeah.
Like
Yeah.
I honestly believe, as like people, and at least in the United States, as like people and individuals, like I don't think that we can allow that. We're not going to let that happen in terms of being
Yeah.
productive and creating things. And also, as technology continues to make things more efficient, and that
Mhm.
may be a solution with rising payroll costs and wages, is that like, all right, well, at some point the technology may have been too expensive to replace a person, but now
Mhm.
maybe getting to like somewhere
Yeah.
close to parity of where, okay, maybe some of this technology actually could replace some people, and they can get jobs fixing the machines or something.
Yeah, I think that there's still innovations that could happen. And I also think that we're not standing on like a house of cards, like we were before the Great Recession. That I'd like to think that there are less vulnerable points in our financial system than there was 15 years ago
I
as
think
well.
in many cases that's absolutely the case. I think that I mean, one example of a house of cards, would be the crypto industry and the
Yeah.
amount of derivative products, because
Mm.
that whole industry got very complicated in the last 5 years or so. Where at first it was just buying a coin, buying Bitcoin or whatever and selling it, and then it got into you're going to arbitrage against different exchanges. But once all the stable coins really ramped up in popularity and all the derivative products and the lending and BlockFi, um, it's the same thing with if you watch the Big Short and what happened in 2008, of where there
Mhm.
were underlying assets and there are all these derivative assets that just compounded and compounded and compounded the losses, and you had so many people who were like, oh well, Bitcoin's going to 100K, then it's going to go to 1 million, and so they're using all kinds of leverage and different types of derivative products and things that were supposed to be backed by or pegged to whatever actual fiat currency, the US dollar. And it's like, they're not necessarily. And so there is, I think, a house of cards in that space. And the question is just how exposed is the global financial system to
Yeah.
the crypto industry? And I think this is going to be incredibly healthy for crypto. Because I mean, I've been a a proponent of cryptocurrencies since like very very early on, 2012 or so. But that not that it's all good. It's not a solution for everything. But I think crypto is going to go through a period. And what I'm getting back to is I think there could be again some effects from this fallout that we're not seeing just yet, because there are
Yeah.
some what we saw in 21 um, was the kind of the institutionalization of crypto. And so many larger financial institutions were taking stakes, whether that was in crypto companies or exchanges or in the coins themselves. And how tied to it all are they all? I don't have as good of insight, but it is something I think it's worth watching.
Yeah.
And I think it goes back to showing the strength of real assets, though. Getting back to
Mhm.
real estate, kind of went off on a tangent,
Oh, no,
but
it's like the growth markets may not be doing as well.
no,
You may not be able to buy a stock that's like 30 times overvalued of it, when
yeah, a company that's not making money and
yeah, yeah,
yeah, betting on the future. All right, well, Matt, let's just get into the data.
yeah.
You want to look at CPI first,
Oh,
just to give
definitely.
everyone a little quick update.
Yeah,
What
so,
do you got for us?
just to run the numbers really quick, and we can talk about them in just a second. The overall CPI was up 0.4% month over month in October, which was the same as September. But this time, the zero point 0.4 number is being celebrated rather than being greeted with the trepidation that it was greeted last month. I think the expectation was higher this month, and now that it came in at the same rate, then we're cheering. And last month we saw zero point 0.4, and we thought that it was a little bit too high because the previous month was zero point 0.1. So we're happy about this number. Year over year inflation is at 7.7% for all items. Now, for core inflation, which does not include food and energy in its calculation, that went up 0.3% last month, which cut last number's month in half. So it is up 6.3% year over year. I think this core inflation number is really one thing to really keep watching, especially as gas prices continue to get higher and higher. Um, Shelter and the overall housing market is up 0.8% month over month and 6.9% year over year. And drilling down into the rent of primary residence, that is up 0.7 month over month, which is a slight decrease from 0.8% last month, and is up 7.5% year over year. So it really shows how much shelter is a part of inflation. It is, I think you mentioned this earlier. It's about a third of the force behind inflation right
Yep,
now. 30.
2.6%. Yeah.
So it's driving it. It is not yet going down, at least not significantly. It could still float. It's almost like you're looking at a star and you're looking at like millions of years in the past. That's how they're measuring rent.
Yeah. Hmm.
I don't see it going down. It could start going down relatively soon, but not very quickly. One of the things that I've noticed about the CPI numbers is they may be lagging indicators, but they're also sluggish indicators. They don't dip down as quickly, and it takes them a little bit more time. But again, all the private reports like from RealPage, Yardi Matrix, Apartment List, whatever, they're seeing rent growth go down. And so we are definitely looking at the past. It's just
And one of the big differences, Matt, and not to get into the full like calculation of how shelter is calculated in CPI, but the big
mhm,
difference is that a lot of the rent reports that we report on, talk about, and people usually refer to are looking at market
yeah.
rate increases. What the market rent is, what is currently being charged today, just the same way, like what is the price of gasoline today, not what you put in your car last week, but what it is today. Whereas the way they measure CPI or shelter in CPI is they're looking more at a effective rent and just what people are paying, not necessarily taking in to looking at market rent, which sort of makes sense in a way that that's what people are paying,
Mhm,
but it doesn't give you a good insight into the way the market is moving. Because
yeah.
if it's like, yeah, someone locked in a price that's relatively high 6 months ago, well, that has nothing to do with the way prices are going, and nothing that the Federal
Mhm.
Reserve could do is going to change a price that someone locked into 6 months ago.
Yeah. I do think that there are signs that renewals are starting to cool off. Based on there's a recent Real Page report that talk about how loss to lease is changing in such a way that it really
Mm,
does indicate that like we're finally kind of uh, all of those crazy rent increases are finally kind of circulating back into renewals, and we're getting to a much
yeah.
more normal pattern here. So hopefully, we'll see that reflected in the CPI rent report. But I'll need to refresh myself and see how much of a lagging indicator it really is.
Yeah. Yeah. All right, let's move on to
Mhm.
a little labor market info. We got a
Yeah.
nice little piece from the National Association of no, it's the National Association of Home Builders.
Yeah,
They put
so
out some good stuff.
they
But
had
I got
one and CBR had one. Really, this is just an excuse to talk about the employment numbers that came out last week. Unemployment went from 3.5 to 3.7%. The NHB they say that labor market has softened in October. Um, as should already be abundantly clear, I'm not an economist, but I do think that like the consensus among economists is that full employment is between 94 and 96%. A 3.7% unemployment rate leaves us well within the range of full unemployment, but I know it's coming because my experience with oversimplified economics discussions is the minute you talk about the unemployment rate, someone's going to talk about the labor force participation rate.
Mhm.
And my hot take is that when you're talking about how low the unemployment rate is, the labor force participation rate is not as powerful a counterpoint as it used to be. I just don't like it fluctuates and it's a lot more different of a number than you might think, especially if you're looking at the 25 to 54 year labor participation rate. If you are looking at the total labor force participation rate, it is really skewed by the baby boomer generation. And as the baby boomers retire, the labor force participation rate naturally goes low. So you don't really see it
Yeah.
doesn't really track as much. It tracks baby boomers just because of the outsize
They're the
size.
ones leaving. They're the ones leaving
Yeah,
the market.
yeah.
Yeah.
So if
It's a
you look at
demographic. It's a demographic thing. It's
yeah,
hard. Yeah.
and so if you look instead at the 25 to 54 year labor force participation rate, then you can see that we're within a percent or so of we're really back to essentially where we were pre-pandemic. What do I have the numbers here? Well, I don't. Oh no, yeah, labor force participation was at 83.3% early in the Great Financial Crisis before it started sinking. More recently, it was at 83.1% pre-pandemic before it started sinking. Its post-pandemic peak was 82.8 in August of this year. It's currently at 82.5. We're in the 83% ballpark. That's still on the high end of what we've seen in the past 20 years. I think that I think that the unemployment rate is great. The labor force participation is, all things considered, pretty great. Um, And so really, to return to that headline that the labor market is softening, I think that a 0.2% increase in the unemployment rate right now, it doesn't look like much of a trend. You can even, unemployment was around 4% in January, and it's been in the upper to middle 3% range all year. It was 3.7% in August, down from 3.5% in September. Now it's back to 3.7. I don't see a consistent trend. It's a little bit up and down. It's bouncing, really small bounces too. I'm going to wait for a big bounce to really start freaking out and say, it's really softening. So I think that, yes, our current unemployment rate looks great and is close to the lowest it's been in 50 years. My concern is that every time the unemployment rate gets this low, there's a recession that sends it up again. There are some periods of 2 to 3 years. This is where I was losing myself in charts a couple nights ago. There are some periods of 2 to 3 years. I saw them in like the 50s, 60s, and 90s where unemployment was close to or at, kind of around 4% for an extended period. You have like a sweet spot of 2, 3 years where you were doing great. But it's not the usual case where unemployment stays at a low point for such a long period of time. It's like it gets to this sub 4 point threshold, the sub 4% threshold, and then it goes shooting up from a recession. That's just the pattern that I see. And that's one of the things that I mentioned makes me nervous is, are we, are we just adding dry tinder to this inflation fire that it will only be cured by high interest rates in a recession? So that's everything I know.
And how much of that is a natural cycle, and how much of that is, the Fed kind of forcing our hand? Because in all of those cases, for the most part, there was some kind of interest rate increase that
That
broke the
in that
market.
that was my assumption too, is this wages went up, inflation started getting really hot, and then the Fed cooled it off. It keeps happening. There is this cycle, and I don't know if we're getting ready for another year or two of decent stability, or if we're gonna go right back up again. That's that kind of remains to be seen, especially in the employment numbers that we're seeing. It's not a significant enough trend for me to start thinking, oh, well, things are really heading up. Like when things started going up in the previous recessions, you saw like not a 0.2%. Sometimes it was like
Mm.
uh, 0.5% or 1%. These really steep monthly increases in unemployment. So there's still some time before things get really dangerous.
Yeah. Well, it'll be interesting to see. We're seeing a lot of layoffs in the tech industry, which we talked about. Kind of makes sense with their valuations and the money.
Mhm.
Just the faucet of the free money has been turned off. But when it really starts flowing into other industries, non-tech related, when we start seeing the layoffs, which we are starting to see some. So I do see some of the cracks forming in the water coming through the walls.
Mhm.
Just locally, I've heard there's been a handful of layoff announcements, and
Yeah.
nothing that's like moving the needle in a huge way, but I think it's something to watch, of not just how many jobs are being lost, but which industries are those losses coming from.
Yeah, and that actually is a good segue into the CBRE report, which does reference how there were two different jobs numbers that came out. There's an establishment survey which looks at companies and employers. There's also a household survey where they survey the households, and they each capture different things. Right now, the establishment survey showed far more job gains than the household survey. I don't think it means that we're in a recovery. It's just another crazy mixed up number in this like crazy mixed up year. There, so these the CBRE, what they do is they pull things tight together in a series of bullet points that are effectively, they kind of get to the heart of what these employment numbers mean for commercial real estate investors. Job gains were shared broadly across many different sectors of the economy. Wage growth is at 4.7% year over year, ticking up 0.6 last month. Worth noting is that last month the CPI was 4. We're kind of tracking with the CPI inflation right now. So, and we may be in some select cases a little bit above CPI, which is great for for wage growth discretely.
I think we're
And
still
maybe
negative real growth. So isn't it 0.4, 7%
so
annualized? something like
So
that?
the CPI, oh yeah, no, we're year over year annualized, we're at 4.7%. But
Yeah.
6%, or I'm sorry, 0.6% was the wage growth shown, and
Mm,
that was about the same
yeah,
as
that's great.
the CPI numbers. So I think it's great for wages. I don't know if this is the preface to inflation, but I'll put that aside right now. I want to talk about the
Probably.
good stuff.
Yeah. Yeah.
I think CBRE correctly highlights these job numbers as a snapshot of an active, vigorous economy. It quickly notes the implications of these strong job numbers. Yes, things are great now, but what about the future? We're always kind of thinking, and they're saying that continued strong job and wage growth will keep the Federal Reserve on course to hike interest rates, with a 50 basis point increase expected in December. And they say higher interest rates will negatively affect the job and real estate markets over the next several months before they start to recover toward the middle of 2023. As a snapshot, again, it seems like we're doing great. As an indicator of the future, it looks like we're headed towards more interest rate hikes. We'll see. I wrote this last night or 2 nights ago. So like, we'll see what the CPI numbers show. CPI numbers were fairly positive. I don't think they were dramatic enough to really dissuade the Fed's course. But that's again, that's my hottest of hot takes. So I would definitely agree. Maybe a 50 basis point next month. Maybe we'll see more layoffs, and then they won't kick it to 75. I don't, but it's hard to see these happy signs and not see what's on the horizon.
Yeah.
There's some momentum to this inflation and that's what otherwise, if we didn't have inflation that's still pushing us, then like the numbers this month could be the sign of stability. But the context is we're on the tail end of inflation, or we're not on the tail end. We could be on the beginning of serious inflation, and so we don't know what the implications are, rather than like, well, better raise rates, because that's something that you can kind of
Yeah.
control.
Now, I just want to maybe circle back on a little bit of this, maybe contextualize. Okay, what does that
Yeah.
mean? I'm here. I'm an investor. I'm thinking about maybe investing in apartments, maybe not investing
Mhm.
in apartments, or maybe some other commercial real estate, maybe the stock market. And just looking at apartments, though, this all seems scary to be investing in anything right now. You don't know,
Mhm.
but higher inflation for longer is good for the apartment industry.
Yeah.
It can be not great for valuations because cap rates could rise with interest rates, and so that hits your valuation. But if you're a cash flow investor, which we are, this translates to higher cash on cash returns over time, because rents
Yeah.
historically always outpace inflation. So when I hear, well, we're going to have a little bit of inflation for a little bit longer, what I hear is rent growth is going to be a little bit higher for a little bit longer,
Yeah.
especially when you talk about wage growth. If wages are continuing to grow, that means rents are going to continue to grow as well. And so if you're positioned, you have the right type of debt, you're going to make a lot of money over the next couple of years. And then talking about that worst case scenario of basically having a lost decade of growth. Well, if that's going to happen, I might as well get paid along the way, you
Yeah.
know, 7, 8, 9, 10% every year, cash flow as I get through this.
Yeah, no, that is something, and I'm glad that you kind of hooked it back into the apartment market, because it's something that I was thinking about, especially, you know, if we're seeing wage growth, and we aren't seeing inflation go too crazy that would indicate a recession. The thing that you really got to worry about is interest rates. But if you've got a plan for that, then
Yeah.
inflation is great.
And once the interest rates normalize, and cap rates find where they're supposed to be based on demand and growth, then it's going to be easier to do deals. People were doing deals when interest rates were much higher, and they actually had much
Yeah,
higher cash on cash flow because cap rates were higher.
yeah,
So the cash flow goes way up. Maybe you're not banging out a 40 IRR in 2 years. I never got in the business to necessarily do that anyway. I was
mhm,
long-term cash flow, really creating wealth by, holding for longer. Not that you can make a ton of money doing shorter deals, turning and burning, but that works when it works, and it doesn't when the times change. And the times
yeah,
have changed. You can't always count on that, because we look at it in simple terms. Typically, you like on an average return for a most commercial real estate, but most investments, you're looking for like a 2x multiple over 5 years. I'm going to double my money over five
mhm,
years. For 3 years, you're going to triple your money. Well, obviously, if you can just do, instead of tripling your money over 10 years, you do 2 5-year deals and you 2x in 5 years, and then you 2x in another next 5 years. You're compounding, and you're
Yep.
getting a 4x. So obviously 4 is higher than 3, but that is assuming that that same deal is like you can get the same returns and the same deals available in 5 years. If
Yeah.
not, the market's in a bad spot, then you don't have any opportunities, then there's nothing. And especially if you
Yeah.
have to make an early exit because that's how you set up the deal, it may not be anywhere near that.
Yeah, that's the shorter the time period of the investment, the more chance that you could get caught on the wrong side of a downturn.
Yeah,
But
it's risk and
yeah,
return. It's risk and return. You
yeah,
can have a higher potential return, shorter the hold, but a lot of shit's got to happen like the right way,
yeah,
right?
yeah,
And so if it doesn't happen the right way on the right time, if you get slow to get your business plan started, you get the wrong loan. It's short term. We all just said rent's going to keep rising with inflation, but we're seeing right now a correction in rents right now. We're seeing
yeah,
rent
yeah.
declines in most markets. And so you
Hmm.
have to be able to weather through that. And if you have a 24-month business plan, you have rental declines and you just have complications for 6 months. I mean,
Hmm.
that's a quarter of your hold period. You're on a
Yeah,
bridge loan, terms come and due, the valuation's upside down, rates are way up, you're in a bad spot. But if you have a 5, 7, 10 year time horizon, well, 6 months is relatively immaterial. It's like
yeah,
5% of the whole period. So, you can get through that, and then you stabilize and you've got the right debt in place. And what I like is the certainty of making a lot of money goes up.
yeah, yeah.
Like, you're going to make a lot of money. It may just take a little bit longer to do it, but maybe you end up making that that 4x over 10 years
Hmm.
because you're in the right real estate and you had cash flow throughout the period. And the biggest thing is you don't lose because
Well,
you can get a high
yeah.
return, but you lose on one. And it just sacks your average in a second.
And for managers and kind of operators of these assets, it gives them more of a chance to put their own work into it and rather be, the performance is linked to what they're doing and rather than like the whims of the market
Yeah,
increasing over time.
absolutely. All right, Matt.
Mhm.
Voters said yes to affordable housing on Tuesday. Is that the case?
So I foregrounded this with economic news, even though I knew that like everyone's still thinking about the elections. I'm not going to talk about really controversial stuff as much as the stuff that's
I
relevant
think the
to
viewers want to
the
hear the controversial stuff,
the
man.
hottest of the hotter takes. The
They
more
would
the
like,
more
I think
uninformed,
that
the better. That's my favorite. I have too much of a sense of humor, and I'm too ambivalent about politics in general
yeah,
to really give a hot take that's worth anything. And I liked this article. They run down a lot of the ballot measures that were passed or maybe in progress at the time of the article that have to do with things like rent control. There were some bonds that were issued for affordable housing and other things that were connected to regular housing issues like there's a couple places in California where now you can't let the building go vacant for more than six
yeah.
months or so. And there were, but by and large, the biggest proposals that were voted on and approved were the ones that give money for affordable
All
housing.
right.
There were a couple of rent control measures in Santa Monica, Pasadena, and Portland, Maine, and those ones passed with over 50%, but it wasn't overwhelming. The vast majority, like I said before, were these bond measures that address affordable housing crisis in places like Berkeley, California. They give 650 million. San Francisco, I'm not sure if San Francisco did, but Oakland, California set aside 350 million. North Carolina around the Asheville area raised 40 million. Charlotte 226 million. Austin, Texas 350. We're approaching $1 billion total in just these ballot
Is
measures.
this how we should raise money, Matt? We just put on a ballot measure.
I'm very persuaded that we should.
Yeah,
Columbus, Ohio, Palm Beach, in Kansas City, Missouri. Kansas City, Missouri. We've mentioned how there were some affordable housing activists there, and it already has
mhm.
among the lowest rent to income ratio in the city. But they are giving 50 million in additional bonds to rehabilitate, renovate, and construct affordable housing. So
Yeah.
there's a lot of stuff going on, a lot of money that is being spent give to build additional affordable housing. A much smaller percentage of this kind of end band-aid solution of rent control. I don't think that those are as as palatable
Yeah,
to
I
me.
I mean, as because I talk to investors a lot of times, and rent control can be a huge concern to them, and rent control is a concern that's floating out there. Fortunately, though, most people who are serious about housing have identified and come to the conclusion that rent control, really
Yeah.
doesn't really do much, and we just really the problem needs to be more supply,
They
and
may
so
hate the landlords, but they also know that
yeah, yeah,
it
but
doesn't
like,
work.
but you need yeah, but you still need the housing, and
Yeah.
it seems to be. I don't see too many people opposed to building more affordable housing. I mean, it
Yeah.
seems to be
I agree.
pretty much consensus.
Mhm.
So I'm hoping that this is, starting of a trend for more dollars for affordable housing. And
Yeah.
I don't think anyone's really figured out like the best solution for affordable housing, how we build enough. Because the one thing that y- it's in a sense, like it's could be some huge corporate welfare for a lot of these, real estate developers for building
Oh,
this
yeah. Oh,
affordable housing. Like
for
it's a
sure. Yeah.
and now it's like we need to have it. People they need to be compensated for doing the work. I mean, you can't make the
Mhm.
money the same way as for building market rate, and so you want to reward people, incentivize it. Why would people do it if they're not going to make money? But like, but having knowing enough about it to be dangerous, it's like these deals can be very profitable for the developers, and is
Yeah. Yeah.
very much a form of corporate welfare in many cases. But there's no. But how else do you do it?
Yeah,
You
because
have
if
to.
you're too careful, if you're spending all the time trying to figure out the best way to not to do this frugally, then it's gonna slow down everything.
Yeah.
Um, and
Yeah,
so
you gotta do something, and the government's not gonna do it on their own, and
yeah.
just, individuals out there, it doesn't pencil to build you can't build B or C class product. I don't even
Yeah.
know people say that, like, "Why aren't we building B class?" It's like, well, what I don't even know how you build it new, and then it's like the jeans that you put through the machine that, like,
That's
beats
right.
them up,
You
like, you make
bury it
new
in the yard
jeans.
and then it looks older.
Yeah, like, "Oh, yeah, knock off the rent." Because the building of the building, like, it costs about the same regardless. It's the finishes of what you're gonna charge, and the
Yeah.
finishes, it's not that much more expensive to put in, like, a little bit of a nicer, like, countertop in, like, that's
Mhm.
so, like, it's the all the other soft and hard costs that go into building it, so it's like, well, yeah, we'll spend, like, a couple hundred more dollars on the nicer countertop, and we'll be able to charge, like, $600 more. Like, obviously, they're gonna do that.
Yeah.
Um because they wouldn't be able to pencil it otherwise. They wouldn't be able to pencil the development. It barely makes sense anyway.
Yeah.
So, I think that at least progress is being made on the front of supplying more affordable housing. There's a lot of people getting involved, and I think it's great
Mhm.
stuff. When I say corporate welfare, it's not like necessarily something that shouldn't be done. These people that are doing it shouldn't receive, all the compensation that
And
they're
it's our
getting.
work.
But it's just it's just one of those things that um it's just an interesting topic
Well,
going through some
and
of those performance
And the
fees
article
right now.
that we read in New York Times talks also about all the hurdles that these developers, especially if it's affordable housing, you got to find the land, you got to fight the neighborhood, and it's going
Mhm.
to fight you every step of the way. So a lot of that that was that story that they had money in the bank ready to be spent. They just couldn't find a plot of land sometimes to spend it on. So that's I can kind of understand if prices get elevated there because you're waiting around
Yeah,
and that means money.
yeah. All right, Matt, last report on the Gray Report,
Mhm.
for this week is we are gonna take a look at the PwC's Emerging Trends in Real Estate 2023. This is a great report that you can find on the Gray Report. You can get it in our newsletter. You can go to PwC, and you'll take 10 minutes to go to their website to find it. Just go to the Gray Report. We'll link it to you right away. Um, but I mean, I think the actual like PDF is like 100 pages. So
Yeah.
we're not going through all of it today, folks. Don't worry. But I would recommend that if you want to really go take the deep dive, do it, or just listen to what Matt and I are going to have to say here over the next couple of minutes.
Yeah.
Um,
This
Matt,
is
what are
this
some of
is
the key
from
takeaways?
yeah, I'd love to share them because they're one of the key takeaways that I wanted to signal is like I really like the writing in this. A lot of times it's the data and I kind of skim over and I look at a good graph, but like I think it was particularly well written. And so kind of kudos to the individual authors, and I think probably to the editors who are like, no, spend some time making a good paragraph. Maybe even use a semicolon if it's appropriate.
So not written by AI.
Yeah, not written by AI. It's very sure. I posted this again. It was last week. I think it's well worth including here just because of how great it was. A lot of great information about all the kind of different commercial real estate types: multifamily, single family, industrial, office, retail, hotel. They do a great job of pulling in different pieces of information from a lot of different sources to compare the trends within each market. The prevailing mood, is what they say is that the prevailing mood among real estate professionals is not much different from what we have been talking about on the Gray Report. The authors quote, "Find it striking that so many people in the industry are willing to look beyond cyclical headwinds. As one real estate professional told us, we'll look back in 10 years and the prices that seem astronomical today will seem like a bargain." That's kind of what we were talking about, 5 minutes ago. Not to repeat myself, but we don't find this mood to be quite so unusual or unexpected. I don't think it's so striking to us because we kind of understand that, yeah, the period of our investment is often longer than the cycles that they're describing, or at least longer than the down, than the valleys of any economic cycle. Also, as optimistic as investors are in the long term, the short term plans were as actively wait and see as possible. If you can kind of, it seems like it's a very protective and cautious atmosphere. There may be a rush to finish a deal or two before the end of the year, but this is likely temporary as investor capital is expected to shrink and debt terms are expected to get more stringent. And it says, while interest rates are increasing, equity and bond prices have been falling, triggering the denominator effect for some institutional investors with asset allocations that must remain in balance. The denominator effect can be magnified because CRE values in a portfolio are generally appraisal based, which tend to be backward looking. Would you be able to put that in context? I'm not really.
Yeah. I mean,
I don't know
you're
what the
you're
denominator
taking
effect is.
well, the denominator effect is essentially you're looking at we're looking at a cap rate calculation of
Okay.
NOI
Okay.
divided by your cap rate, and so as your
Okay.
cap rate is expanding, obviously that's going to decrease your value,
Okay.
but also it's a delayed effect because the numerator in the calculation, your NOI, is also taking a snapshot of in the past. So you're looking at your past 12 months performance, which could be different from your current performance, higher
Mhm.
or lower. For example, in 2021, valuations moved away for many, especially on the acquisition side, away from looking at T12 financials, but looking at T3 financials because there's so much rent growth that looking at 12 months in the past wasn't a
Mm.
good indication of the current performance of the property. And since the properties are traded on the income that they produce, I want to know what the income's producing today, not last year.
Yeah.
But in years past, the difference between today and last year was relatively marginal. But
Mhm.
that's just not the case today.
Okay.
And so I believe that's what they're getting at.
Okay. So that's all right. That really helps. And typically, so they go over like kind of that was the general mood of investors and CRE professionals, and they also do a nice overview of the housing market. I appreciate the effort they spent explaining how hard it is going to be to build new housing supply and all the difficulties associated with building a house during the pandemic, which has meant that housing doesn't come onto the market as quickly, and that the housing that does come onto the market, which you said this last week, and I thought was particularly useful. This housing that comes on the market will need to be more expensive in order for builders to recoup their costs. And if their debt is more, if they have more costs because of inflation or whatever, these builders, yeah, they could take a loss. That's not going to be their first choice. Their first choice is going to be to raise the price of things to kind of balance their books. So I thought that was particularly interesting. And another thing that I thought was interesting is that they say that in this environment with unaffordable housing, where new homes have high prices that don't really bring down local home prices enough, we could see increased migration to more markets where housing is cheaper. They Remote work has continued to the extent that it is making mobility a little bit easier for people. I'm not sure if it's going to happen en masse, but it is one of the factors that they talk about here. Um, I know I said that there were some clever turns of phrase and nice writing, and I also appreciated there was some references to the classic 1961 urban planning treatise, the death and life of great American cities, and it shows this is just the stuff they're bringing in. It's not all numbers and figures. Sometimes they have some Jane Jacobs, and that's nice. Here's a specific quote where it says, and this is just from the report, and they're kind of dealing with all this stuff about the progression of real estate here. And it says, if a city area only has new buildings, the enterprises that can exist there are automatically limited to those that can support the high costs of new construction. How boring and monotonous that would be. Jane Jacobs points to all the small local businesses that occupy those local structures that give the neighborhood its diversity and vitality. Typically, a report aimed at a broader audience will go for a simplified account of the issues at play, judging correctly that readers don't want to be bogged down. But this report's kind of throwing curveballs, and I like it. They're talking
So,
about
Matt,
how older buildings are nice
yeah,
and yeah, I like it.
aesthetically for the more the stuff that's in between the lines, the aesthetics, not just all the
Yeah,
numbers and figures.
yeah.
And Matt, you do have a background in
I
literature,
know. Yeah. I,
so
I did. Yeah, I do have a
you're
literary
probably like
background, so it's
keen
like,
in on that.
like
But it
yeah.
is nice. It is nice to see a
It
little
was
bit.
like a magnet here. But they also, and it's not just like pretty words and prose or whatever. It
No, the
does
amount of
have.
data in this report is really awesome.
Yeah, yeah. There's
Yeah,
some nice, really useful charts, and so it's not short on that as well. It's not short on the words here, but going back to kind of their overall trends, they identified 10 of them over through the pages, and a lot of these are ones and so this is what they think, though, is going to characterize 2023 and beyond. They say normalizing, which is a return to typical asset performance, not the real kind of supercharged growth that's expected. Persistent changes like remote working arrangements, which I kind of alluded to when we're talking about the ease of migration, maybe.
mhm,
Capital moving to the sidelines as investors go into wait and see mode and debt gets more expensive. The next is that housing remains unaffordable, and that's a problem that is and will be difficult to remedy. Also, that real estate investors are becoming increasingly selective, with greater attention to higher quality or niche assets. And they're also talking about repurposing, converting, or continued utilization of older buildings. That will facilitate the rebalancing of CRE demand. They also say that varied performance in the high-flying Sunbelt markets of 2021 will, you know, uh, will kind of chasten maybe some of the people that were all in on the Sunbelts. I think that it's not going to be as 100% growth as it was
mm,
before. There may be some markets that will still be incredible performers, but it's
yeah,
not going to be an easy win. Just to close your eyes and point somewhere south of the Mason-Dixon. I don't know.
yeah.
They also talk about smarter, fairer cities through infrastructure spending. This one sounds like a government spending thing. Can't speak to the specifics of this one, but my guess
I
is
don't know
that's
what
going to
that
be
means, Matt.
it's like a local market issue, is my opinion,
Yeah,
rather than a broad trend. It's like you got to get your own government involved in that. Climate change, I don't disagree with this. And now this is a hypothetical, but what would happen if, and I'm thinking of the hurricane in Florida a month or so ago. What would happen if every 5 years a hurricane hits the same city? My question is, how often does extreme weather, whether it's an earthquake or a hurricane, how much does that have to happen and kind of wipe out a home before insurance costs make living somewhere prohibitively expensive? I'm sure we have a long ways to go before people move away from any coastline in America, but how much insurance are people willing to pay to live on the beach? Again, it's a hypothetical, but what if it gets to the point where people have to pay the replacement cost of their home every 5 years in cumulative insurance payments? Is that going to, because at the end of the day, they are taking insurance money out of their homes, and the insurance has got to balance their books, and if they have to pay to rebuild that house, with greater and greater frequency, those premiums are going to go up. And so it's not going to be like, it's not a climate change thing. It's not a government, safety thing. It's like an insurance problem.
yeah,
That's what it seems like to me. But
yeah.
that's my climate change thing. And then the next thing is it talks about action through regulation, which deals with like ESG and rent control, which is a weird one, only because the rent the regulations and policies they cite here have an unmentioned counterexample in what I think is an increasing acknowledgement of deregulation as a driver of housing supply increases, specifically seen in the White House's own housing supply plan, a way of kind of removing obstacles. Yeah, there could be action through regulation, but I also think that removing regulation is going to open the doors for some people, make it easier to
Yeah.
build more houses.
I've seen quite a lot of outflows out of ESG funds recently in the United States. I think in Europe they're still kind of going strong on it, but I think that there's a lot of I think people are kind of questioning the whole ESG narrative. Not that they don't like the ideas behind it, but are just very
Hmm.
skeptical of the greenwashing that's going on, of being a lot of lip
Yeah,
service.
I think that without specificity, and there are, I've heard about ways that you can, buy off carbon offsets that are kind of questionably, that may lead to like ecological destruction because they're planting trees where they shouldn't be planting, or just there's a lot of question marks. I think it gets really, you can't just pay $50 and say, yeah, oh yeah, 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 don't worry about your don't worry about your pollution anymore.
Yeah.
It's there's a lot of people doing that, and they're doing it all in different ways. And yeah, once I can get a real good handle on this, I might trust it more. But yeah, I don't roll my eyes for
Well, just
anything,
let's
but
all
like I don't
do
want
the
people to
right.
get tricked.
Why can't we just do the right thing? We all don't need like a sticker and like a label to to do the right thing for society. Like how about that? Let's like make it sustainable. And sustainable means like profitable also. Like
Yeah,
you can like have the resources to continue to do what you're doing,
yeah,
and doing it in a way where you're not going to screw over society and the environment. Why don't we all just do that and not, get up all on our high horses and say we're, all I'm only concerned about ESG and saving the world. Well, yeah, let's all let's just do the right thing, and
yeah.
not just like get a label so I can get investors who want to feel good about themselves, because that's all it is people who have made a ton of money,
Mhm.
multi-generational wealth, and they feel guilty about having all this money.
Yeah, I don't even mind, like, I don't even mind spending 50. This is my hypothetical $50, maybe it's whatever, 50 million. If I invest in something and they're telling me, oh yeah, this is going to go to solar panels, or part of it is going to go to protect this, or we're doing these things in this way, then that's fine, and that could be a factor. But I don't like yeah, I think that putting a label, putting a sticker on it is covering something else up. It's always has to be doing that. And
Yeah.
so I just like details more than anything else. I don't have any problem with their interest in the environment. But I do think, yeah, when you're putting a label on it, you're covering something up, and someone's making money off that, and probably not in the most forthright, honest, or intended way.
Yeah, I agree. I'm skeptical. Want to do the right thing,
Yeah,
but
yeah.
a lot of
Going
grifters out there.
Yeah, for sure. I think that, so going into the multifamily section specifically, now there is
Yeah.
so much in this report that's like it's going to be impossible for me to cover, and I was already writing too many too many words in my notes, just trying to skim it. But there's just one passage here that I thought really summarized things very effectively, and it said that still the throes of land use policy drag on development. This is a quote from the report. But beyond local policy barriers, tugging housing to its future are a trio of macro forces: work-life balance, an urgency to stall the climate effects of global warming, and an array of technologies in business management, livability, and construction. Can this darling of real estate asset classes sustain its hold on global investment inflows, unleash construction's modern manufacturing era, turn the tide on local political will, and win over the hearts, minds, and pocketbooks of consumer households to pull off such a feat? If you had to guess today, with rental vacancies at historical lows of 6.2% and occupancy rates and median asking rents for vacant units at historical highs, the answer would be a cautious yes. I think that tied in so many different things, flowed really well. I enjoyed reading it. I think it was a really well written couple of paragraphs there. It talked about global warming, that may have an effect on things, but the policy barriers and this land use policy thing is really going to be an interesting tension. Is how much are the local neighborhoods going to fight against anyone that wants to bring in more housing in an area? Because otherwise, then the growth is going to still continue happening in the suburbs.
Yeah, agreed. Well, for more information on the full PwC report, make sure you're subscribed to the Gray Report newsletter. You can go to graycapitalllc.com/newsletter. And if you're not already a subscriber of the Gray Report, you got to be. So go hop on over to the Gray Capital YouTube channel. Make sure you're subscribed. Leave a comment on one of the videos. This video, again, tell us where we're right, where we're wrong, and we will typically feature that comment on the show and give you a response. Typically pretty much on it. Matt, this is a great set of reports.
Thanks.
This is good stuff. Any closing comments? Thoughts?
No, I think that it's
Aspirations?
yeah. It's time to let's not be nervous. We're going to take a month off from being nervous. We're just going to try to work really hard.
Let's do it. Let's do
right.
it. All right, everybody. Thanks so much for watching the Gray Report. Catch us every Thursday for the Gray Report newsletter and every week for the Gray Report podcast. And again, not only on YouTube, you can find us on everywhere you can get your podcasts. So if you're on the road, working out, doing something where you can't watch things, but you can listen, that's we got an option for you there. And if you're like, all right, I think these guys are saying something that resonates with me from an investment standpoint. I'm a accredited investor. What are these guys doing? Well, we've got a multifamily fund. We're seeing all these opportunities come up. We're getting ready to hop on. We're using fixed debt, long-term holds, stable markets, cash flowing properties, putting a ton of our own money into it. Some of the highest co-investment levels you'll ever see. So again, if you're a accredited investor, this isn't an offer to invest. Hop on over to Gray.fund, learn more about the Gray Fund and some of the exciting opportunities we've got coming your way. We'd love to have a conversation with you, see if it's a good fit. All right, everyone. Matt, thanks again.
Thank you.
Everyone will see you next week on the Gray Report.